Hey everyone, welcome back to Corporate Decoder, the place where we dig into those juicy corporate filings and find the real story this week. It looks like MIRA Pharmaceuticals is giving us a pretty interesting look under the hood. Let's see if they are on the path to a blockbuster or a flop. So, Michigan Rough Pharmaceuticals incorporated its quarterly report for the period ending the 30th of September 2025, and while it's a long document, we're going to cut through the jargon and get to what really matters. Stick around because we've got some intriguing financial shifts and strategic moves that could impact their future. And if you dig these kinds of breakdowns, make sure you're subscribed. We also have a Discord community linked in the description below where we discuss these kinds of insights further. Let's start with a key number. As of the 11th of November, 2025, MIRA had over 418 million shares of their common stock issued. That's a lot of ownership spread around. Now, let's peek at their balance sheet. This is like the company's financial snapshot. On the 30th of September, 2025, MIRA had about $2.6 million in cash. That's down from nearly $2.9 million at the end of last year. They also had a boost in short-term investments, jumping from $0 to almost $4.9 million. This big jump is linked to an acquisition they made. Overall, their total assets grew significantly from about $2.9 million to over $7.6 million. On the flip side, their total liabilities saw a big drop. They went from over $723,000 at the end of 2024 down to just about $84,000 by September 2025. That's a huge reduction, which is generally a very good sign. Looking at stockholders' equity, the number of shares issued and outstanding nearly doubled, from around 16.5 million at the end of 2024 to over 39.5 million by September 2025. This heavily fueled their additional paid-in capital, which grew from about 31.3 million to over $41.1 million. However, their accumulated deficit also widened. They've lost over $33 million cumulatively. This suggests that while they're raising money and issuing stock, they aren't yet profitable and are accumulating losses. Now, let's talk about their performance over time, how much money they made and spent. Their revenues were flat at zero for both the 3 and 9 month periods in 2025 and 2024. This is typical for a company in the development phase. What's interesting is their operating costs. General and administrative expenses were about $900,000 for the 3 months ending the 30th of September 2025, compared to just over $1 million in the same period last year. For the 9 months, these costs were about $3.4 million in 2025 versus $3.1 million in 2024. These are mostly costs related to running the business like salaries and professional fees. More importantly, their research and development expenses dropped significantly. For the 3 months ending the 30th of September 2025, they spent about $412,000, a big decrease from over $1 million in the same period last year. For the 9 months, R&D spending fell from $2.4 million in 2024 to $1.2 million in 2025. This reduction is mainly because they spent less on developing their MIRA -55 drug candidate, and the bottom line net loss. For the 3 months ending the 30th of September 2025, they reported a loss of about $1.1 million. That's much better than the nearly $2.1 million loss in the same period last year. However, for the 9 months ending the 30th of September 2025, their net loss was over $4.4 million compared to over $5.4 million in 2024. So, they're losing less money, which is a positive trend. But here is where things get a bit complicated. They recorded a deemed dividend of over $21.5 million in the 3 and 9 months ended the 30th of September. 2025, this is a bit of accounting magic that effectively reduces their net income available to common shareholders. This large figure is tied to an acquisition you'll hear more about. Because of this, their net loss attributable to common shareholders for the 3 months was a staggering $22.7 million. Looking at the statement of changes in stockholders' equity, we see a lot of activity. They issued new shares of common stock, especially under something called their at-the-market or ATM agreement. This is a way for companies to sell their stock on public markets. For the 9 months ending the 30th of September 2025, they sold shares and made about $3 million after costs. The acquisition of MIRA Pharmaceuticals incorporated on the 29th of September 2025 was a big deal. MIRA issued almost 20 million new shares of their common stock to the Scani shareholders, valued at about $26.3 million. Now let's check the cash flow statement. For the 9 months ending the 30th of September 2025, MIRA used about $3.5 million in cash from operations. This is mostly due to their net losses, but financing activities brought in a healthy $3.3 million. This came from selling stock through their ATM agreement and from stock option exercises. Interestingly, they had a non-cash item where they increased short-term investments and issued common stock for an acquisition. This was worth over $4.7 million. That's a significant non-cash transaction. So what's the story behind all these numbers? MIRA Pharmaceuticals is a company developing drugs for neurological and behavioral disorders. They have two main drug candidates, ketamine 2 and MIRA 55. Ketamine 2 is in clinical trials for pain and other disorders. MIRA 55 is in early research for anxiety and cognitive decline. They also mentioned important regulatory clearance from the DA that neither compound is considered controlled. The big news here is the acquisition of Accession Pharmaceuticals, incorporated on the 29th of September 2025. Accession was a related company, meaning they had common owners or ties. This acquisition brought Accession 1 into MIRA's portfolio, a drug candidate focused on metabolic and behavioral issues. This brings us to a critical point, the going concern note. This is where companies have to be upfront if to raise a real question about whether they can stay in business for the next 12 months. MIRA explicitly states they have substantial losses. Their ability to fund their operations and trials depends on getting a lot more money soon. They estimate they have enough cash to last through the third quarter of 2026, however, they say they will need additional financing. If they can't get that financing, they might have to cut back on operations. This is a pretty serious warning. Let's dig deeper into that Accession acquisition. It happened on the 29th of September 2025. MIRA acquired Accession, and as part of this deal, Accension's largest shareholder contributed over 3.5 million shares of MIRA Pharmaceuticals, incorporated a publicly traded related party. These shares were valued at about $4.7 million at the time of the acquisition. The excess fair value of the MIRA shares issued over the net assets received, which was over $21.5 million, was reflected as a deemed dividend. This is a complex accounting treatment often used when a related party transaction results in a distribution that resembles a dividend. Stock-based compensation is a big part of MIRA's story. They estimate the value of stock awards to employees and directors using a model called Black-Scholes. For the 9 months ending the 30th of September 2025, they granted options to buy common stock to board members, officers, and consultants. The fair value of these options was about $87,000. They also granted restricted stock units, or RSS. In total, Michigan recognized about $1.8 million in stock compensation expense for both options and RSS in 2025. This is a significant expense and dilutes existing shareholders. They also have warrants outstanding. These are like options that give the holder the right to buy stock at a certain price. As of the 30th of September 2025, they had about 1.76 million warrants outstanding with an exercise price of almost $4 and a remaining contractual term. Looking at events after the reporting period, in October 2025, MIRA sold more shares through their ATM agreement, bringing in about $1.2 million on one day and another $2.5 million on another. Also, their CEO Erazaminov exercised stock options, bringing in over $590,000 for the company. These are all cash-generating events happening after the financial quarter ended. Digging into the management's discussion and analysis, they reiterate their focus on developing ketamine 2, MIRA 55, and now Accession 1. A key highlight was the FDA clearing their investigational new drug application for ketamine 2 in July 2025, allowing them to start US clinical trials. They also announced positive preclinical data for MIRA 55 and their topical ketamine 2 formulation, showing promising pain relief results. The acquisition of Accession Pharmaceuticals was also a major point, as it brought in a new drug candidate for metabolic and behavioral disorders. A critical point here is their NASDAQ listing status. MIRA received a notification that they weren't meeting the minimum stockholders' equity requirement of $2.5 million. They submitted a plan to fix this. And it seems the Accession acquisition and subsequent stock sales helped them regain compliance as of October 2025. Even though they seem to have met the requirement for now, the report warns that there is no assurance that we will be able to maintain compliance with NASDAQ's listing requirements. This is a constant risk for companies in this stage. So, what's my take on MIRA Pharmaceuticals? On the positive side, Michigan RA is actively developing a promising pipeline with significant progress in clinical trials and regulatory approvals, particularly for ketamine 2. The acquisition of SNI adds another potential growth avenue in metabolic and behavioral health. They are also adept at raising capital through stock issuance and option exercises, which is crucial for a company in this phase. The reduction in their net loss is a good sign that they are becoming more efficient with their spending, especially in R&D. However, The company is still burning through cash and carries a significant accumulated deficit. The going concern warning is a serious red flag, indicating substantial doubt about their ability to continue operations without more funding. While they've regained NASDAQ listing compliance for now, it remains a persistent risk. The heavy reliance on stock issuance to fund operations dilutes current shareholders, and if not managed carefully, can lead to significant shareholder value erosion. Investors need to be very comfortable with the high-risk biotechnology sector and MIRA-specific approach. In conclusion, MIRA Pharmaceuticals Incorporated is a company with potential, backed by promising drug candidates and strategic acquisitions. But it is a classic high-risk, high-reward scenario. They are navigating a challenging path, with profitability still a distant goal and constant pressure to secure financing. Their ability to successfully bring their drug candidates to market and manage their cash burn will be key to their survival and success. What's your assessment of MIRA's current situation? Are they on the right track or facing too many hurdles? Let me know your thoughts in the comments below. If you found this breakdown valuable, please hit that like button and subscribe for more deep dives into corporate filings. And don't forget to join our Discord community for more discussions and exclusive content. Thanks for watching, and we'll see you in the next one.